Hello and welcome to United Asset Strategy's second quarter investment recap. I'm Thomas Healy, Chief Portfolio Strategist here at United. With me today is Matt DeLorenzo, our Chief Investment Officer, and Jiorden Sanchez, one of our Senior Portfolio Managers on the equity side. Looking at the second quarter, there was a lot of the continuation in trends of what we saw in the first quarter, most notably the fact that both stocks and bonds are down. And as we mentioned last quarter, it's fairly unusual. About 10% of the time that you have both asset classes down in the same quarter. Having it 2 consecutive quarters has only happened about 2% of the time in the last 50 years. There are several silver linings to this, though. The first being the fact that active managers tend to outperform in more volatile down markets, and that's the case here at United. In fact, every one of our equity strategies is ahead of its respective benchmark by an average of about 3.7%. The other silver lining is the fact that our fixed income and equity traders are actively harvesting losses in taxable accounts, which will really benefit our clients from a tax perspective. But looking at the first half of the year, the S&P is down about 20.58%, while the U.S. Ag Index, the leading bond indicator, is down 10.4%. Again, it's highly unusual to have both asset classes down concurrently, and it's really because the headwinds are facing both asset classes are similar, those being inflation, interest rates, and geopolitical risk. And so I want to start with Matt to kind of walk us through what he's seeing on things like Federal Reserve, inflation, and rates. Matt?
Thanks, Tom. Yeah, so as we entered the year, we had high inflation that was really no surprise to anybody, but it actually accelerated as the year proceeded. A lot of it had to do with the Russian invasion and what that did to energy prices, and then some things lingering that were in effect last year as well. So the biggest implication on stock and bond markets is that the Federal Reserve really accelerated its plans to address this. So the biggest thing and the biggest summary I could give is that they took steps to what they call moderate demand, the demand side of the equation, by raising interest rates and proceeding with quantitative tightening, which is a complete reversal from last year.
Right. And I think what I would mention is the fact that the Federal Reserve you're seeing success in that it is slowing the economy. That's a key goal. You're seeing it in the manufacturing numbers, you're seeing it in the consumer confidence numbers, now you're seeing it in housing, and it's also starting to show some signs in the labor market. So the Federal Reserve is slowing the economy, which is their goal in reducing inflationary pressures. I'd like to hear what Jiorden and his team are seeing on the equity side.
So yes, the equity markets are certainly focused on 2 key risk factors. One, higher inflation and what that means for higher rates and lower equity valuation multiples. And 2, those same higher rates and what that means for a potentially slowing economy and downward earnings revisions. Now, the underlying consensus expectation is that we're probably working through these headwinds over the next few months, but it's important to note that the market is forward-looking, and some of these risk factors are already starting to get priced into the market. And I think you could highlight that in 3 ways. So one, year-to-date, as of yesterday, the equity markets are down about 15%, so off the lows. But it's important to note that equity pressure is largely a function of contracting equity multiples. Equity multiples are down about 20 or a little over 20% year to date, while underlying earnings are stronger. And the reason why that's important to note is that you're seeing that despite the, at least so far, strong earnings environment we've been in, equity investors are starting to assign a lower value to those earnings numbers given the risks they see. So that's one way to see that it's starting to get priced in. The other way to kind of see that some of these risk factors are getting priced in is where you're seeing the market pressure. So for example, you're seeing growth stocks year to date underperform value stocks by about 15 percentage points. That's what you would expect in an environment where the market is trying to price in higher rates. 2, you're seeing cyclical stocks underperform defensive stocks by a little over 10 percentage points. And that's what you would expect to see in an environment where the market's trying to price in a weaker economy and potentially downward earnings revisions. The last point I would make really quickly as it relates to some of the market reaction is, when we start looking at some of the recent data points, For example, the really hot inflation print that just got reported, the market was effectively unchanged that day. And that's a big difference versus the prior CPI print where the market was trading down 3% on a higher number. And separately, we're approaching about 50% of the way through earnings season, 2Q earnings season. And what's interesting to see is that for the subset of companies that have not meted expectations for the quarter, they're largely unchanged on average around that earnings print in terms of their stock price. And that's very different versus what you've historically seen, where stocks tend to trade down 2 or 3% on weak earnings. So I think taking all of that, it kind of does highlight that the market is starting to digest some of the risk factors that people are very focused on, especially at current market levels.
Great, thank you for that. So given what we've discussed in terms of the environment, economic landscape, rates, Fed, inflation, and being an active manager, I'd like to hear Matt discuss what our fixed income team is doing in this environment.
Sure, absolutely. So one of the most interesting things that's happened in response to the Fed moving towards its aggressive hiking path is that we've seen an inverted yield curve. So generally this is seen as the market's interpretation that the Fed is going to be removing accommodation at a fast enough speed to slow the economy. So one of the things that we've done in response in the bond portfolios is extended duration. So longer term securities in the fixed income markets generally perform better as the economy slows and interest rates come back down. So that's one of the things we've done to position bond portfolios. And then aside from that, just as always, business as usual, looking for relative values in the bond market and what's become cheap given this sell-off. So a couple of things that we can point to are municipal bonds. We've been able to buy some long-term municipals with yields well over 4% for tax-free, very high-quality bonds. And we're finding attractive spreads on fixed-rate callable agency bonds. So it's another way to have a very high-quality security in the portfolio that now has additional yield and upside for our clients as well.
Great. Jiorden, same question to you on the equity side.
Sure. So as you alluded to earlier, we've done a lot in terms of risk management across our equity strategies. And for that reason, we've been able to contain some of the downside year to date for those particular strategies. And look, we run a number of strategies, but broadly speaking, across the strategies, you're likely seeing some mix of the following to manage the risk we see. One, you'll see a greater allocation to cash. That'll allow us to be opportunistic to the extent we're in a volatile environment. Sometimes you find things to potentially buy opportunistically. Two, we've got a little bit more, some of the strategies have, for example, hedges like gold or an inverse ETF. Separately, there's sector tilts towards defensive and away from cyclicals, and then style tilts towards value and away from growth that allow us to kind of manage away from some of the areas that are seeing a lot of the pressure in the equity markets. And then lastly, given the environment we're in, we've also had a subset of strategies really start to focus a bit more on the balance sheet and cash flows, so that these ensuring that these underlying corporations are able to kind of weather any potential storm.
Great. So, it's clear that our investment team is working diligently to help our client portfolios through these choppy markets. But as a firm, we continue to invest in growth in people and in resources. For example, we recently brought on board a longtime industry veteran, Bob Murphy, as our Chief Operating Officer. He joined us from TD Ameritrade. In addition, we added VP of Operations, Allison Sikowski. She came from KPMG. Those two will really help beef up our compliance and operations businesses. We also rolled out a new strategy called Core Quality on the equity side. As Jiorden mentioned, we have value, we have growth, we have dividend. Quality was part of the picture to help round out our portfolio, our suite of portfolios. Again, all this is to give our relationship managers greater resources to help meet our unique client needs and objectives. So with that, I think we want to wish you guys a happy rest of the summer, and we'll circle back next quarter. Thank you.